8 out of 10 new buy-to-let purchases in the UK right now are made through a limited company. 8 out of 10. A decade ago, that was almost nobody. So today I'm answering the question every landlord eventually asks me. Should your buy-to-let be in your own name or in a limited company? Now, I can arrange buy-to-let mortgages both ways, week in, week out, and the honest answer is, it depends. But stick with me because by the end of this video, you will know exactly what it depends on. And you will be able to have a much smarter conversation with your accountant and your broker. One quick thing before we start, I'm a mortgage and protection advisor, not an accountant, so this is education, not tax advice. The figures I mention are right as I record this, but tax rules do love a reshuffle, so always check your current numbers before you act. Let's start with what's actually happening out there. Hamptons, the estate agency, actually tracks this. In 2025 alone, nearly 67,000 new buy-to-let companies were set up in the UK, and that's a record. That took the total number of buy-to-let companies past 440,000, which is nearly 5 times what it was 10 years ago. And as I said at the top, somewhere between 3/4 and 8 in 10 of all new buy-to-let purchases now go through a limited company. This is not a niche tactic anymore. It's the mainstream route. But here's the bit that people miss. Mainstream does not automatically mean right for you. Plenty of landlords are still better off in their own name. So let's look at why the migration happened. Spoiler alert, it is tax. It is always tax. If you own a buy-to-let personally, you pay income tax on the rent. And since a rule change known as Section 24 finished phasing in back in 2020, you cannot fully deduct your mortgage interest from the rental income anymore. Instead, you get a basic rate tax credit worth 20% of the interest. Now, if you're a basic rate taxpayer, that roughly washes through. But if you're a higher rate taxpayer, it stings because you're being taxed on money you've never actually seen. That's the bit that went straight to the lender. And it's about to sting a little more. From April 2027, income tax on property income rises by 2 percentage points. Basic rate landlords will pay 22% on rental profits. On higher rate, that's 42%, and on additional rate, 47%. The tax system has been treating personal landlords the way a parking warden treats a car on double yellows, persistently and without much sympathy. Now flip it. Put the property in a limited company and the rules change completely. The company pays corporation tax on its profit, not income tax. And the mortgage interest is fully deductible. Every single penny as a normal business expense because Section 24 does not apply to companies at all. Corporation tax runs at 19% on profits up to £50,000, rising on a sliding scale to 25% above £250,000. So picture a higher rate taxpayer looking at 42% on rental profit personally from next April against 19% in a limited company with full interest relief. You can see straight away why so many people are making the move. And yes, I have just made setting up a limited company so your buy-to-let's got somewhere to live sound really, really sensible. Even your mortgage can have its own house now. I'll see myself out. Now here's where the limited company route stops looking like a free lunch. That 19% only applies while the money stays inside the company. The moment you want to spend it on yourself, there is a second tax charge to get it out, usually as dividends. And dividend tax just went up. From April this year, basic rate taxpayers pay 10.75% on dividends. Higher rate, 35.75%. And only the first £500 of dividends is tax-free. So if your plan is to live off the rent, the company can end up taxed twice. Corporation tax first, dividend tax second. Run the numbers properly, and for some landlords, the personal route still wins. Where the company structure really shines is when you're reinvesting, leaving the profit inside the company to build the deposit for the next property. That's the pattern I see with portfolio builders and landlords. The company is a snowball, not a salary. Tax is only half the story. A few years ago, limited company buy-to-let mortgages were a specialist corner of the market with higher rates and a short list of lenders. That has changed a lot. More lenders have come in, pricing has narrowed, and just in the last few weeks, we've seen lenders sharpening their limited company ranges again. A gap still exists, but it's nothing like it was. There are differences worth knowing, though. Lenders stress test the rent differently. For a higher rate taxpayer borrowing personally, many lenders want the rent to cover roughly 145% of notional mortgage payments. For a limited company, it's typically nearer 125%. Because of that interest relief, which means slightly bizarrely, a company can sometimes borrow more against the same property. And one more thing, the lender will almost always want a personal guarantee from you. So do not imagine the company means the debt has nothing to do with you. It absolutely does. There's a few unglamorous things you need to budget for. A company needs accounts filed at company's house every year, so you'll want an accountant. And they don't work for biscuits. Expect a few £100s a year at least, more for anything complicated. And stamp duty doesn't go away either. The 5% surcharge on additional properties applies whether you buy personally or through a limited company. And now the big trap. Moving property you already own into a company is not a paperwork shuffle. Legally, it's a sale and purchase. The company buys the property from you, which can trigger capital gains tax for you and stamp duty for the company, both in the same go. There are reliefs for some portfolio landlords, but that is a properly specialist accountant territory. Don't try it at home off the back of a YouTube video, not even one of mine. Rough rules of thumb, and remember, your accountant makes the final call on the tax. Your own name tends to suit basic rate taxpayers, people with 1 or 2 properties, and anyone who wants to rent as spendable income today. A limited company tends to suit higher rate taxpayers, people building a portfolio, and anyone reinvesting the profits rather than drawing them out. Think about the long game too. Companies can make passing wealth down the family more flexible because the shares can move in ways that bricks can't. But they add complexity everywhere else. And whatever you decide before you buy. Choosing the wrong structure and changing your mind later is expensive, as we've just talked about. So here's the plan if you're weighing this up. First, talk to an accountant about your tax position, because everything in this video swings on your income, your goals, and your earnings. Then talk to a good broker about the lending side, which obviously is where I come in. Because the right lender for a personal buy-to-let and the right lender for a limited company one are often completely different animals. And I arrange both for landlords all over the UK. I've also written a longer piece on this exact topic, and the link to that will be in the description below somewhere. I'm Patrick Weightman, your local East Midlands mortgage and protection advisor, serving clients up and down the UK. Drop me a like and a follow for more and hit the links in my bio to get in touch. Your property may be repossessed if you do not keep up repayments on your mortgage, and most buy-to-let mortgages are not regulated by the Financial Conduct Authority. Speak to you soon. Bye-bye.